This strategy made $20,000 in backtesting but lost me money in the real market. If you are trading a prop firm account, this is the exact moment where most traders fail and how to fix it before you blow up your next challenge. In part 1, we exposed the 3 traps that make manual backtesting lie to you: ghost bars, unknown risk reward, and ignoring trading costs. We concluded that to find a real edge, you have to code it. Today in part 2, we do exactly that. We are building a professional-grade Python backtest for the triple EMA strategy from scratch. No black box, just pure logic. We will start with a perfect simulation. A perfect simulation means there are no costs. No spread, no slippage, no commission. You simply enter the position based on your signal. Then, if the edge is actually real, we will test whether the strategy can survive real market conditions. This is the plan. We are going to start with a fixed capital of 10,000 USD. We will risk 1% per trade, which equals a maximum loss of $100 per position, and we will aim for $200 profit. So our risk-reward ratio is 1 to 2. The logic is simple. Our stop loss and take profit are calculated directly from the entry price to ensure that if the stop loss is hit, the P&L equals exactly minus $100, and if the take profit is hit, the P&L equals plus $200. As I said, no costs. Pure strategy performance first. We will start by loading our libraries. We're going to use Pandas, NumPy, eFinance, Matplotlib, and Datetime. Then we load BTCUSD hourly data from June 2024 until today. The strategy parameters are EMA fast, 9 EMA medium, 21 EMA slow, 55. The risk is $100. The reward is $200. Now, step 2 is data acquisition. Why this code? We fetch clean hourly BTC data, and we drop NAND values because EMA cannot be calculated on missing data. If we leave missing values inside the dataset, it could break the P&L calculations later. After loading the data, we can see that we have around 71,000 candles from June 2024 to May 2026. Next, we calculate our indicators. EMA 9, EMA 21, and EMA 21 is below EMA 55, and of course we drop the first rows where EMA 55 is still undefined. Now comes signal generation. The strategy is very simple. Buy when EMA 9 is above EMA 21 and EMA 21 is above EMA 55. Sell when EMA 9 is below EMA 21 and EMA 21 is below EMA 55. I store these conditions as Boolean values, true or false. As you can see, we generated almost 7,000 buy signals and almost 7,000 sell signals. If we inspect the last candles, a true value means a valid signal exists on that candle. Now step 5, the backtest engine. This is the most important part. We simulate trading candle by candle. Position sizing is calculated so that if the stop loss is hit, we lose exactly $100. The formula is position size equals risk amount divided by the distance between entry price and stop loss price. Again, I am not modeling any spread, slippage, or commission yet. The stop loss is placed at 1% distance and the take profit at 2% distance from entry. Now, execution logic. We enter at the open of the next candle after the signal appears. This part is extremely important. We do not enter on the same candle where the signal was generated. Because in live trading, there is no such thing as a perfect fill. If your strategy enters at the exact candle close where the signal appears, you are introducing what is called perfect fill bias. In reality, you always have delay. For example, maybe your stop loss was supposed to be 15 pips, but in reality, the execution delay turns it into 12 pips. Small differences like that completely change results over hundreds of trades. Now we execute the backtest. Since we have many buy and sell signals, I added one important rule. Only one trade can be active at a time. If we are already inside a position and another signal appears, we ignore it until the current trade closes. No overlapping positions. Now let's analyze performance. As you can see, this is a beautiful equity curve. Initial capital, $10,000. That means a net profit of $20,000. Total trades, 1,717. Win rate 27%. Profit factor 149. At this point, most people would think, this has to be wrong. There must be look-ahead bias or some hidden bug. But actually, the strategy logic itself is not broken. Because our executions are based on the open of the next candle after the signal appears. We are not entering on the same candle. However, there is still one issue. I forgot to shift the signal. If you watched my previous video, you already know why this matters. At this stage, the strategy still knows the signal too early. So now, let's shift the signal properly. Signal generated at candle I should only become available at candle I plus 1. After shifting the signals, the strategy still performs well. Initial capital, 10k final capital, 26k net profit, 6k MUT. The number of trades increased slightly from 1717 to 1747. Because before shifting, the backtest already knew the final candle closed before the candle was actually completed. In real trading, you do not have access to that information in real time. So the earlier version included fake trades caused by look-ahead bias. Now we have a more realistic simulation, but even after fixing that issue, the strategy still looks too good to be true, and this brings us to the next step, real trading costs. When you trade, especially crypto or prop firm accounts, you are fighting two battles, finding a real edge, surviving trading costs. So now we apply realistic prop firm costs. Commission, 0.06% spread, 0.03% slippage, average 0.03% slippage, 0.02%, then we rerun the backtest. And this is where reality hits. Without costs, the strategy made $20,000. With real costs applied, the result becomes minus $906. We went from plus 20,000 to losing money. The win rate also dropped from 27% to 25%, and total fees paid reached almost $13,000. Why are the fees so massive? Because this strategy generated more than 1,700 trades in just 3 years. That's a huge amount of trading activity. The more trades you take, the more costs you accumulate. And with a 1-to-2 risk-reward ratio, your profits are simply not large enough to absorb those costs. Another important point, spread and slippage tighten your stop loss in practice. In the ideal simulation, your stop loss was exactly $100. But in live trading, especially during high volatility, spread and slippage distort your execution price. And Bitcoin is highly volatile. So your effective stop loss becomes tighter than expected, meaning trades get stopped out more easily. That's one reason the win rate dropped after adding realistic execution costs. So now the question becomes, is the strategy dead? It just needs optimization. We have 3 professional levers we can improve. First, increase the risk-reward ratio from 1-to-2 to 1-to-3. Bigger winners help absorb trading costs. Second, add a long-term trend filter, so we only trade in the direction of the higher timeframe trend. This reduces noise and cuts unnecessary trades. If we can reduce the strategy from 1,700 trades to maybe 500 high-quality trades over 3 years, the cost impact becomes dramatically smaller. Third, widen the stop loss slightly. A wider stop gives more room against spread and slippage noise. This is why you need to evolve from a manual trader into an algo trader or quant. Manual backtesting only shows you whether a strategy looks good. But algorithmic testing forces you to confront reality, fees, slippage, execution delay, look-ahead bias, and market microstructure. Especially in crypto, trading costs are massive compared to forex pairs like EURU, ST, or GBPU, SD, where costs are relatively small. And this is exactly what we are going to explore in Part 3. In Part 3, we'll optimize the strategy logic, improve the Python engine, and see whether this strategy can actually survive the real market. See you in the next video.